Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, July the 13th. Want to just briefly update you guys on what happened last week in equity markets. It was a pullback in equity markets last week. It was a down week with the S&P 500 down 1.16%. The mid-cap index, as measured by the S&P 400, was off 73 basis points, or down 0.73%, and the small-cap index, as measured by the S&P 600, was off 1.4% on the week. So last week was a pullback. Now we had a great June and a good start to July. So in a holiday-shortened week, with fears of this week's inflation report coming, and fears that the Fed was going to do more, it's no surprise to see a pullback in equity markets last week. Volumes were incredibly light last week. There was not a lot of trading volume out there. And so the overarching headline for the week is, as we head into this week, we'll get the CPI and PPI report, which is the consumer price index, which is the consumer gauge on inflation, and the producer price index, which is the price that producers are paying for goods that they're doing. And the worry was that, oh my goodness, we're going to come in higher, and the inflation numbers are going to come in higher, and the Fed's going to have to raise even more, maybe even 75 basis points when they meet in July, was some of the talk on the commentary last week. However, as we head into this week, we got some great news yesterday and today. Yesterday, on Wednesday, we got the CPI report for the month of June. And the expectation was a month-to-month increase of 0.3%, and it came in less than expectations at 0.2%. What's great about this, too, is headline inflation fell all the way down to 3%. And what's more important on top of that is that the core inflation dipped below 5% for the first time, 4.8%, and we are at the lowest level of inflationary numbers since March of 2021. So what does all of this mean? And then we got the PPI today, and again, it came in up 1/10 versus up of 2/10 versus expectation, and that's month over month. So you're seeing inflation come down and cool. Now, you've heard Chairman Jay Powell during his press conferences speak at all, or what he alludes to is he's not as focused on the core number as he is, or I'm sorry, he's more focused on the core number of inflation than he is the headline. So the headline inflationary data for year over year for June is 3%. Okay, core inflation is 4.8%. Core inflation does not include housing, it only includes rents. So you're not seeing the fall in housing impact the core CPI as much as you're seeing it impact the headline CPI. But what does all of this mean now that we're at 4.8% core inflation and we have a Fed funds rate at between 5 and 5.25? Well, what this means is inflation is now below the Fed funds rate. 1 month does not determine a trend by any stretch of the imagination, but for those thinking that the Fed may have to go 75 or maybe even to 6%, well, we're in restricted territory. What restricted territory is when the Fed funds rate is above the rate of inflation. Well, we just hit that this month. So the Fed has signaled very well that they're going to raise 25 basis points next week when they meet. So be anticipating that. The futures have that around 90% probability that we're going to get the 25 basis point increase. Now, we at River Place don't believe we need it as inflation continues to come down, but the Fed's going to take a hard stance on their fight against inflation, especially after they were a little late to the game when they were calling it transitory back in 2021. So what does this mean for the stock market and equities moving forward? Well, as we entered in this year, we've been talking about it for a long time. Analysts and pundits have been calling for this recession. Well, what's coming to fruition more and more is what we talked about at the beginning of the year, is more of a muddle through economy where growth slows, but there's no hard landing, there's no recession. It just slows and we get through it, and then we move on and go to the next phase. And so employment has not fallen apart. If you want a job, you can have a job, and there's plenty of job openings in this country. There's 9.5 million job openings. Labor participation is increasing, which is typically not what you will see as you're entering into a recession. So what this means is we've had a very narrow market up until June of this year, led higher by the Magnificent Seven. And what you saw in June was a broadening out of that. You saw a narrowing of that last week as we had fears of higher than expected inflation and Fed policy. But now that we have seen that, start following the RSP. The RSP is an ETF. It's the Equal Weight 500 ETF. And start seeing if it starts outperforming the S&P 500 itself. And when it does that, that's a very healthy sign for the equity markets. And what that means is that the average stock is outperforming the weighted index, which is a healthy sign for equity markets. And that's something that we've really seen in the last week or so. So very encouraging that we should continue to see that broadening out of the equity markets. But don't be shocked if we don't have a pullback here or so in the next month or so after such a great start to the year and a great month for June. And as we head into earnings season, there's always corporate surprises and earnings surprises that do come up. So be prepared for those. We will start getting bank earnings starting tomorrow with JP Morgan and through next week, which will be a great indicator for the overall health of the U.S. economy. So if you have questions about what to do heading into this season or how to navigate these challenging times, feel free to give us a call. We'd love the opportunity to talk to you and formulate a plan. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thank you so much.